Hi guys, welcome to a new episode of GoldenEye. Today we are doing a new topic, dissolution of partnership firm. In order to close the books of firm on dissolution, few accounts are prepared. First is realization account. Second, partners capital account. If loan is given, then we will prepare partners loan account. Then cash and bank account. Let's understand this through a illustration second of module 1. Let's start the question. P, Q and R were partners sharing profit and losses in the ratio of 3:2:1. No partnership salary or interest on capital being allowed. Their balance sheet on 30th June 2021 is as follow. Liabilities amount, assets amount. Fixed capital P 20,000, Q 20,000, R 20,000. Current accounts P 500, Q 9,000. Loan from P 8,000. Trade creditors 12,400. Now asset side, fixed assets. Under this, trademark 40,000, freehold property 8,000, plant and equipment 12,800, motor and vehicle 700, current assets stock 3,900, trade debtors 2,000. We will consider gross value of trade debtors in the realization account, and on the credit side we will consider provision for doubtful debts. Cash at bank 200, miscellaneous losses. Under this, our current account 400, profit and loss, debit balance 12,000, which we will distribute in the ratio of 3:2:1 in partners capital account. On 1st July 2021, the partnership was dissolved. Motor vehicle was taken over by Q at a value of rupees 500, but no cash passed in respect of this transaction. Sale of other assets realized the following amounts: trademark nil, freehold property 7,000, plant and equipment 5,000, stock 3,000, trade debtors 1,600, trade creditors were paid rupees 11,700 in full settlement of their debts. The cost of distribution amounted to rupees 1,500. The loan from P was repaid. P and Q were both fully solvent and able to bring in any cash required, but R was forced into bankruptcy and was only able to bring 1/3 of the amount due. Let's start the answer. First of all, we are preparing realization account. Then we will prepare partners capital account, then cash account. Debit, credit, particulars amount. We will close all the assets which is showing in the balance sheet at book value. Assets have debit balance. While closing the assets, debit balance will be replaced by credit balance. It means while closing assets account, instead of debit balance, we will write credit balance. So entry will be realization account debit to trademark 40,000, to freehold property 8,000, to plant and equipment 12,800, to motor vehicle 700, to stock 3,900. In case of debtor, we will consider gross value. So gross value is 2,000, and provision for bad debts we will write in the credit side. By provision for bad debts 100 rupees. So these are the assets which is showing in the balance sheet at book value. Now we will close all the liabilities which is showing in the balance sheet at book value. By trade creditors 12,400. So entry will be trade creditors account debit to realization. Only third party related liabilities we will write in the realization account. Loan from P is not the third party liability, so we will not write here in the realization account. We will make separate account for loan account. There are few assets realized which is mentioned in the question, so entry in case will be bank account debit to realization. Freehold property realized rupees 7,000, plant rupees 5,000, stock rupees 3,000, debtors 1,600. Car is taken over by Q partner, so entry will be Q account debit to realization account by Q 500 rupees, and creditors were paid rupees 11,700. So entry will be realization account debit to bank account, creditors 11,700. Dissolution expenses were paid 1,500. In case entry will be realization account debit to bank account 1,500. So debit balance of the realization account is more than the credit balance, so there will be realization loss. Loss we will share in the ratio 3:2:1. So P's share loss is 25,500, Q share loss is 17,000, R share loss is 8,500. Next is partners capital accounts. Particulars P, Q, R. Particulars P, Q, R. By capital balance brought down 20,000 for P, 20,000 for Q and 10,000 for R, which is mentioned in the question. To current account 5500 for P, 2400 for R. How we get this amount? Let's understand this through a working note. Current account balance 500 credit balance for P, 9000 credit balance for Q, 400 debit balance for R. Debit balance of profit and loss rupees 12,000, which is mentioned in the balance sheet. We will distribute this loss in the ratio of 3:2:1, which is profit sharing ratio. So 12,000 into 3 by 6 is equal to 6,000 debit balance for P. 12,000 into 2 by 6 is equal to 4,000 debit balance for Q. 12,000 into 1 by 6 is equal to 2,000 debit balance for R. So adjusted current account balance 5500 debit balance for P, 5,000 credit balance for Q, 2400 debit balance for R. To current account 5500 for P, 2400 for R. By current account 5000 for Q. To realization loss, which is transferred from realization account, 25,500 P, 17,000 for Q, 8,500 for R. R partner is insolvent. So total debit balance of R partner is 2400 plus 8500. Total is 10,900. So positive balance of R is 10,000. So 10,900 minus 10,000 is equal to 900. Remaining R's debit balance is 900. Out of 900, R was only able to bring only 1/3 of the amount due. So 900 into 1/3 is equal to 300. So by bank, R will bring only 300 rupees. So remaining loss due to insolvency is 900 minus 300 is equal to 600, which is shared by solvent partner, that is P and Q. To realization account, car taken by Q 500. Here P and Q are solvent partner. They will bring cash to make good their share of loss on realization. So by bank 25,500 of P and 17,000 for Q. They will bring cash of their share on realization loss. As per Garner versus Murray rule, solvent partner, that is P and Q, have to bear the loss due to insolvency of partner R in their capital ratio. So insolvency loss is 600. How we get? 900 minus 300 is equal to 600. So they will share their loss in their capital ratio. So capital ratio of solvent partner P and Q is 20,000 and 20,000. It means 1:1. So P will bear insolvency loss of rupees 300. So 600 into 1/2 is equal to 300. By Q, 600 into 1/2 is equal to 300. So both will share insolvency loss equally. To R's capital deficiency 300 P and 300 for Q. We will make payment to P 14,200 and 24,200 for Q. To bank account balancing figure. P's loan account debit credit. By balance brought down 8,000 rupees, which is mentioned in the balance sheet. Payment of loan account. So entry will be P's loan account debit to bank account rupees 8,000. Cash and bank account debit credit particulars amount. To balance brought down rupees 200, which is mentioned in the balance sheet. Cash realized from sale of few assets. So entry will be cash account debit to realization account. Freehold property rupees 7,000, plant and equipment rupees 5,000, stock rupees 3,000, debtors rupees 1,600. Payment made to creditors and expenses. In this case, entry will be realization account debit to bank account. If we do ledger posting of bank account, then we write by realization in the credit side 11,700 creditors, by realization account expenses 1,500. Payment of P's loan. In this case, entry will be P's loan account debit to bank account. By P's loan 8,000. Cash brought in by partners to capital account. P brought 25,500. Q brought 17,000 and R brought only 300 rupees. Payment to P and Q's. By P's capital 14,200. By Q's capital 24,200 rupees. Now that this is done, if you have any doubt, then please let me know in the comment section. Thank you so much for investing your time in me. Thank you.